What's up, guys? Welcome back to another episode. Is this an episode? No. Welcome back to the ProMG Money channel, and we're continuing with the tax-free savings tour. And today we're going to be speaking about a company that's somewhat a bank, but somewhat also, getting into one of the fund managers, and that is actually Investec. Now, Investec, I'm going to group them with a bank because the products I am finding are quite similar to what you'll get at the bank. So they're actually almost pretty much the same as what you get at FNB. So let's get into it. The first part that you have is their just normal tax-free fixed deposit account where you can fix it for 12 months. Minimum deposit is 30,000 rand, and they tell you that it's 100% tax-free. How it works, I think this is just mainly going over how tax-free savings accounts work, what the benefits of it there are, and the minimum and maximum deposits. So a minimum of 30,000, maximum of 36. This is at once, but you can, I'm assuming by them highlighting the lifetime maximum, meaning you can probably transfer your tax-free savings to Investec. I don't like using these future value things because they generally don't nicely work it out. If you'll see on the African Bank video, it kind of doesn't work it out properly because you hit the lifetime limit at a certain period of time. But so we're not going to go over that. And yeah, there it even says transferring funds, so we know that that's how you can get past that 30,000 or 36,000 rand amount. And actually, when you go on over to Investec's rates for all of the savings accounts that they have, you'll get to see that this tax-free actually has a nominal rate of 6.84 and an effective rate of 7%. So I actually think it is right up there with the best, because I think that is also what African Bank is giving. So I think in terms of interest rate, this is actually quite good. I think it is the best that we've had so far, but I stand to be corrected. There's such a whole lot of time in between when I make these videos that actually I sometimes forget what the rates were. So I think this is the best we've had so far. So that bodes well for them. Then when you sort of move on over to the rest of their site and try to kind of see the different options, they do still mention the fixed deposit, but then you actually get to see if you go through Investec online, you can actually pick some of these other options as your tax-free savings account, and you'll see a lot of the names of these funds are quite similar to actually what we had with FNB, in that there's an income fund of funds, there's a balanced fund of funds, balanced high equity fund, just an equity fund, dynamic equity fund, progressive yield fund, and a property fund. So they give you a nice little spread of what you can do. I like that they maybe don't label it similar to how FNB does, and that FNB would put it at different horizons or different times. This one kind of just tells you what the fund aims to do. And let's maybe start at the first one with the income fund of funds, and we're just going to look at the basic fund of objective to see that the income fund of fund is to provide investors with a high level of income and capital stability. That's all you need to know about this, is that it focuses on dividends, or money coming in, but also kind of keeping the principal amount as safe as possible. We're not really going to look at the fund size, when it started, and but yeah, it is. This minimum investment is quite interesting in that it starts at 500,000. So actually, I'm not actually sure if this is so attainable, but this is, the document that I got. I'm sure once you dig deeper, you're able to get it. But the investment charge total is 1.01%, which for something like this is actually not too bad. But as well, it's an income, so they aren't really taking that much risk. So the fund manager doesn't have that much to do. So maybe it's not as great. And as you'll see, risk profile, it's quite low. It does have very consistent dividends. This is looking like monthly. There is some sort of dividends that you're getting for it. I'm trying to see what the unit price is, but it's not actually showing it to me here anyway. So it's a bit hard for me to see what percentage that amount that comes in is versus what it's in. But if you actually look at the asset allocation of this, you'll see quite a bit of cash, and majority of it is bonds. There are a few other things. There's a little bit of property, equity, cash. There is a nice little mix, and they actually kind of show you the different funds that it's in. So it's the Coronation Strategic Income, 91 Diversified Income, the President Income Fund Provider, Matrix, SCI Bond, Nedcore. So fund of funds is really true is that the person who's in charge of this fund or this fund manager has just taken the money and they've put it into other funds and created its own nice little thing here. And I'm assuming that this is the benchmark that they're up against, and it looks like over 1 year they are beating the benchmark, 2 years, 3 years. But as you'll see actually as the years go, kind of higher, you'll see that it gets closer and closer to the benchmark, or the benchmark starts to sort of catch up. So maybe over a year, it's done well, and that's because they move quickly. But what you'll tend to see is that over time, the overall market always beats whoever's doing what, whoever's trying to time the market and those kind of things. So yeah, fund of funds, not a bad option, but it's there to preserve your capital. The next that we have is the balanced fund of funds, and this is to achieve long-term growth of capital and income by investing in a diversified range of assets. So with this one, I would imagine it's looking to grow your money, not at a crazy amount, but also still keep that income coming in. At least this one's initial investment says 100,000, but it's still a bit hectic. But the investment charge is 2%, so it's literally double of what it was before. And I'm assuming it's because this one has a whole lot more going into it. But the income is quite a bigger amount, but it's over a longer period. So June, December. So this happens, twice a year. That's essentially how they do it, and its risk profile is moderate, so it's kind of 2 steps up from where it was before. And if you look over here, you'll see there's domestic equity, domestic bonds, cash, offshore equity, bonds, cash. So this is actually quite a nice mix. It's balanced, as it says. So this would be really good, just as a safe bet. And they actually show you what the top 10 equity is in this one, because they do have equity. Unfortunately, Process is there at the top, and one of these days I'll go into my beef with Process. Not that it's a bad company, I think it's quite good, but this thing pretty much rules the JSE. If Process is down, JSE is down. But yeah, that's a conversation for another day. Process, Anglo, Standard Bank, Impala, Naspers, Tiger Brands, Glencore, Moraine Roberts, Nedbank, and Brait. Then it actually kind of shows you what they've done, and they pretty much show you each of the other kind of funds that they've invested it in. So even to get to these numbers, you can find that how they got there was that they kind of aggregated everything in each of these funds and kind of put it to this top 10 equity holdings. But as you'll see, benchmark over a year, benchmark is winning. 3 years is doing a bit better. 5 years is doing a bit better. 7 years it is doing better. Since inception it is better. So this one, it's doing slightly better, but I'm telling you, once you start to factor in the fees, you would have been better off tracking something that does the South African multi-asset medium equity, or whatever the case might be. And the rest of this, I'm really not going to read it. Next, we've got the balanced high equity fund, and it says the balanced high equity fund aims to deliver consistent growth of capital income over a long term with a bias towards equity investment. So I think with this one, we're not so balanced anymore. It's probably going to have a whole lot more equity. As you'll see, initial investment still 100k, but 1.74, so it's actually not as bad in investment charges. But yeah, it also does have this semi-annual distribution, and you'll see that it is moderate high or mod high, so it's a bit more riskier than where it was before. Let's actually see, and they tell you the top 10 holdings. Investec, WA Core, so that's probably something that they have. A bond, another fund, Anglo, First Rand, BHP. So I think it is a nice mix of things, but I think they even say alternative bonds, cash, equities, which makes up about 50%, and they that's just local. So it's got a nice decent mix. Actually, what I've not been checking to see is if these are regulation 28 compliant, and you see it says yes, and I knew that almost immediately because how it was almost 75% domestic. I knew that this has to be something that then they also use for retirement funds. So yeah, Then you go on over to how it's doing versus the benchmark. Seems to be better over 1 year. Over 3 years, benchmark is better. Over 5 years, benchmark is better. Since inception, benchmark is better. And it goes back to what I was saying, is that the market will always outperform whoever it is you are trying to track, or whatever it is that you're trying to track, because us as humans, or someone who's managing this, will make decisions over what we kind of think or do. The market just does what the market does, and it tends to trend upwards. As you know, stonks only go up, so that's what we're basing this off of. Anyway, next we've got the equity fund, and it says this fund is aimed to provide investors with capital growth and income over a long term. Same old, not regulation 28 compliant, and for me that's a positive thing. That means that money is going to be growing here. Total investment charge is slightly less than what it was before. I think the other one was 7.1, this one is 6.9. Hey. And yeah, income not as great as the others, but this one has got a very high risk profile, so you can tell they are taking chances here. And here, what I like about this is that you're not in other funds. This is the fund. This is the only and one thing that you're in. So I think on fees, that probably even does you even better, because each fund that your fund is investing in attracts fees. So the lesser that you have, the better, even though there are still fees for this. But I think in the end, you end up being better if you're in a individual fund directly. But again, story for another day. Here, they're putting their money straight into equities when they're kind of showing you the different sectors that they're in, rather than the funds or how they've done it before with bonds and mixing the companies. Because here you'll see Anglo, Standard Bank, Nedbank, BHP, Prosus, FirstRand, ShopRite, Naspers, Foschini, and Bidcorp. Those are the companies that they're in, and they've even showed you the sectors that majority are about 72% is domestic equities, and then cash, and so on and so forth. So it is quite decent. If you look at how it's been doing versus its benchmarks, over 1 year, benchmarks are killing it. Over 2 years, it's a bit better, but benchmarks are still ahead. Over 3 years, benchmarks are still better. Over 5 years, benchmarks are still better. Over 7 years, benchmarks are still better. So again, back to what I was saying, is that the market tends to perform better than humans would, but it is what it is. That's the next option. BCI Dynamic Equity Fund, and the objective of this one is to provide with capital growth over a long term. I should probably read this, but it's speaking about bottom-up investment approach that identifies equities that offer above average returns while investing a full spectrum across the JSE. So basically what it means is that they're trying to find one or two things that could really win in the long term, but they kind of also want to have a general feel of the market, and they kind of show you what their benchmark is the JSE capped SWIX. I should probably know what that is, even though I do not. Same old 100,000 initial investment, not Reg 28 compliant. This one I think is the highest fee we've seen so far, at 2.38%. Income distribution, whoa, that was quite hectic, the one that's in June. But it's a bit hard for me to say what this is, because they actually aren't showing me the unit price. Well, actually there it is. The NAV is 144 cents. That's actually quite good. That's a really good distribution, actually. That, I wonder what gave that distribution. I'm sure there was a special dividend or something somewhere that led to that. But anyway, when you come here, all of these companies, this is Mount Took Renewables, Anglo, Sabvest, HCI, South 32. So a bit more of the mid to lower cap JSE companies, but things that when they move on a day, they make quite a significant move, versus when you have your standard banks, when you have your Anglos there, when they move, sure, they will over time make a certain direction, but it's really not that much. These guys tend to move the needle quite a bit more, and you'll see the asset allocation over here is domestic equities is 94%, so they're going really hard on the JSE here. If you look at how it's done versus its benchmark, over 1 year, it's looking pretty good. Over 2 years, good again. 3 years, killing it. 5 years, still doing quite good. So this one is actually doing quite well to beat its benchmark, and I think yeah, so far this is looking like a really good choice of all of the ones we've looked at so far. I mean, 36%, 58% over 2 years is really great, particularly in this climate. I think they've done pretty well there. Then you've got the progressive yield, and the progressive yield is a flexible portfolio with the objective to provide investors with a starting yield on the investment of 2% above the all share index, then to grow the initial yield at a greater rate than inflation over a 3-year rolling period. It's a lot, but anyway, you keep going down, you'll see it's not Reg 28 compliant, 2% flat. That's decent. Seems to be giving income on a monthly basis. It's moderate to high, so it's not taking heavy risks. And you'll see the first thing that's there in the holdings is a treasury bond, so you can tell that there's a bit of a mix here. But when you come to the asset allocation, you'll see domestic cash. I believe that's what that is probably one of the biggest sections that you have here. So it's, yeah, not looking to take too many risks. 1 year is 22% since inception, so this is quite new. You can tell it's quite new if it's only got that to compare it to. It's even got 2021 versus 2022 returns. So this one still very fresh. I wouldn't say that you might get into directly, but yeah, this is inflation plus 3%, which is at 8.8, so it's doing quite well versus that. And the South African multi-asset flexible, it's doing pretty well versus that, but this one needs a bit more time. It's still quite fresh in the oven here. Last one we're going to look at is the property fund, and the fund objective is to provide investors with growing income stream that can translate to capital over the medium to long term. Okay, it's fine. Benchmark is the JSE property index, not Reg 28 compliant. Very high fees. I think it's probably the highest at 2.32, even though there was something else that was more or less there. Income seems to be random. Oh no, it's monthly. No, I think this is a monthly income. That's why you're doing this. Moderate to high. When you come down here, top 5 holdings are Napier Rock, Castle, Growth Point, Redefine, Resilient, and Serious Real Estate. Why does no one like the one REIT I'm involved in? No one ever does Vugilia. But anyway, how they've done versus their benchmark, worse. Benchmark is down 1%, they're down 3%. Over 6 months, benchmark is up by 6 them, it's 5.3. Over 1 year, benchmark is 26, they are 24. So they also aren't doing too well versus the benchmark. But yeah, these are kind of the options that you have. If I were to choose, based on all of these, I think for sure this is the one I would go with, the dynamic equity fund. It is quite high. It's 2.38% the fees versus the 2.6 of the other one. But I think what it's done over time, it's had quite a long way to go, and it's doing pretty well. I know this 36 is what's enticing me, but really what's getting me is this 12% there, which if I'm not mistaken beats the S&P 500, and that's what you should always be aiming to do. So this is what I would do. But based off of that, I would say Investec actually has the best options of the banks. I would put them actually above FNB and Standard Bank, but it's also because they are leaning more towards the other side of this, where they are more of a fund manager or investment people rather than just a bank. FNB's business first and foremost is to sell you a banking product and sell you something like the secondary. This is Investec's job. This is their bread and butter, so it's understandable why they're doing better. But yeah, I think that is all for today. I'll catch you guys in tomorrow's video.